welcome back to the Beyond Wealth Advisors monthly economic update. I'm John Cleaver, CEO and Private Wealth Advisor, and with me today is Scott Hawker, Financial Advisor. Welcome, Scott.
Thank you, John. Thanks for having me today.
Absolutely. Well, we're back for some more, and there's a lot moving right now. Geopolitics, markets, interest rates. So today we're going to cut through the noise and focus on what really matters. And Scott, let's start with the headline everyone's watching, and that's the conflict between the U.S. and Iran. What's the latest, and what should investors really care about?
At a high level, we're now about 6 weeks into the conflict, and expectations have shifted. Originally, this looked like a 4 to 5 week situation. Now it could stretch to closer to 2 months. But the bigger issue isn't just duration. It's how this ends.
Yeah, that's the big question for sure. Let me pause you there because I think that's where people can get lost. Is this really less about how long it lasts and more about how it resolves?
Exactly. Markets would clearly prefer a negotiated settlement, but realistically, a unilateral ceasefire is more likely given the lack of diplomatic ties. Either way, the key takeaway is this. Markets are already looking ahead to normalization of energy supply.
It's crazy how that works. So even with this uncertainty, the market is trying to price the end, not just the conflict itself.
That's right, John. But in the meantime, oil prices, volatility, and headlines are going to drive short-term moves.
Yeah, and that's where discipline matters because those short-term moves can pull people off course, and if they're not careful, really get them sidetracked.
That's right. John, let's shift to equities. We saw a strong rebound last week. What stood out to you?
Well, what stood out to me is that what the market didn't do, it didn't panic. You know, even with oil hitting multi-year highs, the S&P 500 still posted a strong week. And I think there are 3 clear signals investors should be paying attention to right now.
Okay, so walk us through those.
Yeah, let's do that. So first, context matters. Since the conflict began, the market's down about 4% with a peak drawdown of about 9%. Compare that to history. Even mild recessions tend to see declines well over 20%.
So markets aren't pricing in a full recession at this point, at least.
Well, not at this point, and we're really seeing something closer to, maybe a 30 to 45% probability of a recession. That's very much in line with broader forecasts. So second, we get a real-time playbook of how markets react.
Now, this is really fascinating.
It really is. A little knee-jerk reaction at times, but when there was hope for a ceasefire, markets rallied, cyclical sectors led. When rhetoric escalated, markets sold off. Those same sectors took a hit. So direction, not just headline, is what's really mattering right now.
And that gives investors a framework instead of just reacting emotionally, right?
Well, for sure. And, that third key component right now is that markets are forward-looking.
Yes.
And even with rising oil prices, equities rebounded because investors are looking through this disruption and focusing on the underlying economic strength.
So the market is already asking, what does the world look like after this?
Scott, that's exactly right. And let's move to fixed income because that's another really important area. And this is where I think there's some real shift happening that investors could act on now.
Absolutely. The 10-year Treasury has moved from about 3.97 up to around 4.3%. That's a meaningful move, higher in yields.
And for a long time, investors really weren't getting paid to take that risk. And so that's changing in a meaningful way.
Exactly. Higher yields mean better income opportunities. At the same time, spreads are widening slightly, which is typical of uncertain environments.
So what's really driving this move right now when you think about fixed income?
2 main factors, John. First is inflation pressure from oil, and the second is geopolitical uncertainty impacting Fed expectations.
So the Fed's still very much in the middle of this, isn't it?
Oh, of course. Of course they are.
They can never step away. So when you look forward, what's the range that we should be thinking about when it comes to these kind of yields?
There's a general view that around 4.5% on the 10-year is a ceiling. If we start to see slowing growth or labor weakness, rates could move back down.
Okay. So that really creates an important window right now for investors to act on.
Exactly. Income investors are finally getting paid again. John, if we simplify all of this, what should investors actually be focusing on at this moment?
I would narrow it down to three things. First is direction of the conflict, escalation versus de-escalation. Second would be oil and inflation and how that feeds into the Fed policy. And then third would be the underlying economic strength, especially the consumer and labor markets.
And importantly, the worst case scenario still seems highly unlikely.
Yeah, I think I feel the same way. A major disruption to global energy infrastructure is not the base case. And the oil market itself is signaling that the supply should normalize relatively quickly once all this ends.
Which reinforces that markets are already thinking ahead beyond this.
Absolutely. And then markets, that's what they do. And so I guess here's how I would frame it. Markets are navigating the uncertainty, but they're doing it with discipline. We're not seeing panic. We're seeing recalibration. That's a really important distinction. Because in environments like this, the temptation is to react to the headlines, to the volatility. But the opportunity is to step back and ask, what is the market actually telling us about the future? And right now, it's telling us three important things. One, the economy is holding up. Two, income is back on the table, as you mentioned. And three, the market is looking beyond this conflict. So stay aligned, stay disciplined, and make decisions that position you for the next headline and what comes after that.
John, that's very well said.
Thanks, Scott. And as always, if you have questions or want to talk through how this impacts your financial plan, we're certainly here to help. In times like this, it's probably more important than ever to reach out to a financial advisor. Ask those questions that are just on your mind. And that's what we're here for, and we certainly encourage that. And as always, we want to say thank you for joining us, and we look forward to seeing you again next month.